Hey guys, this is Dave with Moniology. Hope everyone is having a great weekend. This is the weekend market review for November 11th and 12th, 2017. Happy Veterans Day to those of you in the United States. And for those of you who are new to our videos, what we do is we take a look at the markets from daily, weekly, and monthly perspectives. We analyze some of the important sectors in the markets to help us get a better understanding of where the markets have been, where they're going, and how to find the sectors that you want to be in and those that you want to avoid. So let's have a look at what's taking place in the markets today. So starting with the 10-year U.S. Treasury yield, which helps us understand kind of where fixed income is headed, possibly where dividend stocks are headed, and as well these affect precious metals and commodities. So this is a very important sector to understand. And we've been pointing out for the last couple of months here that interest rates have broken out of a downtrend here. This is taking a look at the daily chart. And right at this point last week, we pointed out that we might be in a point of consolidation, possibly correcting all the way down to 21 for the next couple of weeks. But this week, we really had an up move here. We found support at the 50 EMA and of around 23 area. Now we've rallied. The question is, what happens here at this level? And we'll see this week. Can it break through 24 and ultimately make that crucial test of 25 happen? Or is this just a fake bounce and we head lower toward this corrective pattern? We'll see. At this point, I'm kind of skeptical until the MACDs break above 0, but ultimately the bullish narrative is one that we're very strong on here. We've said for a while that this bullish pattern that we saw take place in November, where we broke out of a long-term downtrend, is indeed intact, and now after a multi-month consolidation, corrective consolidation in 2017, we broke out of this bullish flag pattern. We've kind of retested here and consolidated above that 22 level, and now we're looking to make a run higher. And if we break above 25, that's our prediction, and it's going to happen probably at some point this year. We still might consolidate for a little while, but once we break out of this, that's going to be a sign that the next leg higher in interest rates is on its way. So stay tuned, and very interesting developments here. You look at interest rates on a monthly chart from 1994, basically. We've been in this basically interest rates have been going lower and lower and lower since that point. But in 2012, something happened. We hit a low here, and we rallied. Then we hit another low here, and we kind of double bottom. But notice here, this double bottom had divergence. This RSI level right here is higher than RSI was last time prices hit this level, which when this successfully held at 15 or slightly below 1350, but created this double bottom divergence, that was a sign for many traders that this indeed was a long-term bottom. And sure enough, we broke out, massive hammer pattern here on the monthly, broke out of this downtrend that we've seen since late 2013, and now we've consolidated in this bullish flag pattern here, and we're starting to break out again. So have a look at, keep your eye on 25. If we break out at 25, we're going towards 30. That probably coincides with the 3 level on the 10-year Treasury. So many pundits have been saying that 3 level is crucial, but this 25 level is very, very crucial as well. So stay tuned. We think that 30 is going to be tagged at some point this year. Gold on the daily chart, we had a bit of a pullback this week because we ran into some very strong resistance, coincided with the 50 EMA, daily EMA at 1285, the middle Bollinger Band. So no surprise we kind of pulled back, but ultimately notice here that although we broke below the 50, back below the 50 on the RSI, we're creating this bullish divergence. We're creating a stair-step pattern higher, and ultimately we think this resolves itself to the upside, well above 1300, ultimately retesting that 1360 level and likely headed towards that 1400 level at some point this year. Looking at why do we say that? Well, what we always do is we have a weekly and a monthly picture in our minds as we look at the daily and hourly charts. This is an uptrend that started in 2016. We've consolidated here since July of 2016. Now we finally broke higher in July of 2017. Now we're consolidating again, but we're consolidating. What's crucial is we're consolidating above this breakout point. We're right below the 50 on the weekly RSI. We believe that this is going to break higher very, very soon, and when it does, there's going to be some significant upside ahead. Gold monthly further adds credence to this narrative. Look at this downtrend since 2011. It's a downtrend that's been nasty. It's killed a lot of companies. If you've owned this sector as I have, many times it's crushed us in many ways. But notice if you look at the long-term time frame since 95, we're in an uptrend since basically 2000 in gold. And this is very often you have this massive move up and now this bullish consolidation pattern, and we're starting to break above that. And when these consolidated patterns break higher, that creates this new leg of this multi-year uptrend. It's kind of a continuation pattern. So ultimately, notice here we're finding support above the 50 on the monthly RSI, and no surprise here. And so once this move does resolve itself higher, it's going to be powerful. And this is why you want to look at these sort of sector charts, because this is where it tells you, hey, look at junior miners, find the names, do your due diligence on some of the higher names, better names in the sector, and you're going to do very, very well if this narrative plays out as we believe it will. Taking a look at high yield. So high yield is an area that you want to really, really follow if you want to understand kind of where the credit markets are in the overall stock market. And what high yield is showing us is that things are kind of weakening, and not sure what the fundamental narrative behind these are. I really don't care. Ultimately, it's suggesting that high yield is selling off, which means yields are going up. The spreads between the more credit-worthy names and those that are more junk are widening, which means that the probability of a recession is increasing. And so far, we had a nice hammer pattern here as we bounced from oversold levels. I don't think this is gonna hold up very strongly, and ultimately we're gonna break lower. Why do we say that? Well, take a look at the weekly chart. We've been saying this for a while. We broke below this bearish wedge pattern in July. We've rallied higher and kind of double topped in terms of we rallied and we tagged that top point of this wedge around 37.50, but at the same time we had divergence. So we never, even though we had higher high here, we had slightly lower highs in RSI, and finally we broke down below that crucial 60 level on the weekly RSI, and we're going to tag 50 at a minimum. And so does that coincide with the 50 EMA of 35.92? We think so. So let's see what happens here, but ultimately look at this volume. I mean, this is huge. So does that mean that buyers are coming in to start to buy, or someone is really starting to sell off because they see some great clouds on the horizon? We'll see. But look at the monthly chart. Monthly chart is very, very overbought conditions still, so still very bullish from a monthly perspective. But as I've been pointing out, the volume has been decreasing as we've been rallying to new highs. As well, the MACDs are starting to curl towards zero. If this breaks below zero, mark my word, that's going to cause a recession to happen. Don't know why, but I believe that if this happens, and I'm not saying it will, but if these cross below zero, that's going to be a multi-month period of basically credit yields on junk bonds going much higher, and therefore the value of these bonds going much lower. Have a look at crude. So crude is one area that we've been very bullish on, and we still are, but we think that there might be a multi-week period of consolidation now that we broke out above 55. You want to see this consolidate above the 55 area, possibly shake out a few longs above 55, and possibly find support around the 54 area. Ultimately, we think this is headed towards 62, 63 this year, and this is actually the first stages of a multi-year inverse head and shoulders pattern, which we'll point out. But ultimately, here are some great opportunities in the sector taking place. We've pointed out some on our watch lists, RLOG, EVEP, LGCY, etc. There have been some even penny stocks like Seadrill, SDRL have been really killing it because what we found is that once a sector really starts breaking out, there's some huge opportunities, and whether you're a penny stock picker or you like big names, large cap companies, there are a lot of opportunities, and this is why you want to look at sector reviews like this to really understand what's going on underneath the surface of the market. Crude oil weekly. Well, here's the story. So we broke above the 55 level. Now they're finding some resistance around the 200 EMA of 57.61. Probably going to consolidate, create another bullish flag, and then ultimately break higher. Why am I so confident on this picture? Well, because RSI here is higher today than it was at any point than when we were at 55 previously. So we broke out of a major resistance around that 60 RSI level, and now the next major point of resistance is around that 69.70, which kind of coincides with this 112 level when we hit a price high here. So ultimately RSI is very bullish right now, and that leads me to believe that price is going to follow. Taking a look at the monthly, this is the inverse head and shoulders we were referring to. If this neckline breaks above that 60 level, expect this to mark the end of the bear market in crude oil and the start of a multi-year bullish trend in the sector. Taking a look at the NASDAQ, well, in the NASDAQ, I'm going to breeze through these because they're still very bullish between NASDAQ and the S&P, but we're starting to see a little bit of corrective action taking place where RSI is starting to weaken. Still overbought, but on the weekly chart. And the monthly chart is still very overbought, but the price action is kind of similar to what we're seeing on long-term junk bonds, where we're breaking below in bearish wedges, and so these take many months to resolve themselves. But very often, this is the first sign that we're going to have some corrective action in the markets. Looking at the Russell has been very weak for the last 2 months here, and while we might find some support here at the 40 level on the RSI, which coincides with the support that we had here and here and here, kind of the last breakout that we saw in August, if this doesn't hold, we might bounce to the 50 level, but ultimately we think that this is going to head lower, and ultimately Russell breaks below that 200 EMA, if nothing else than to wash out some longs here. Taking a look at the Russell weekly, again, we found some very strong resistance in RSI 70 level, which coincided with periods of resistance in the past, and now we're weakening. We broke below the 60 level on the RSI here, so it adds credence to the point that likely we're going to test this level around the 1350 level, in my opinion, where we wash out longs who are long above the 50 weekly EMA. And ultimately, we might even go towards the 200 weekly EMA, but we'll see. And on the monthly chart, again, no surprise that we're breaking lower here because we broke below this wedge on the monthly, and RSI here is meeting very stiff resistance at the same point where we broke down last time around this 1220 area. And where we went from 1220 all the way to 943. So that was the last basically corrective action in the small caps, and it started right over here. And now this is the point where we are today, where we had new highs relative to here, but momentum was lower here than it was here. So contrast that to oil, where the price is nowhere near where it was in 2014, but momentum is higher today than it was then. So that's what you want to see in a bullish trend, and not what you want to see in a bearish trend. S&P kind of correcting itself, so very interesting developments here. Still bullish on the weekly, but there are some yellow flags, we'll say, starting to develop. Taking a look at the dollar. So the dollar is an index that's extremely important to so many different sectors. It's starting to break below, as we've kind of predicted it would. It had this nice rally here, but it met stiff resistance above the 200, below the 200 EMA. Now it's starting to break lower. The MACDs are now below zero, and so we believe that this is just a continuation of the downtrend that's been in place since basically the start of 17. And no surprise, we met resistance at the 50, and now we're correcting back below, and ultimately this is going to get pretty ugly if it cannot hold this 92 level, so stay tuned. Finally, having a look at the monthly on the US dollar. Again, it's just this is still a very, very bullish pattern when you look at it from a multi-year perspective, but this still is going to head lower, in our opinion, towards at least 87.50, possibly as low as 80 on the US dollar, because it's meeting stiff resistance at the 50 RSI and ultimately heads lower here. Finally, a couple more sectors. Volatility index. So this is a line that we drew here on the daily. It's kind of this daily this bullish flag pattern. We broke out above it. Now we kind of consolidated above that breakout zone, and we're starting to move higher, and RSI is building momentum here. We're at the same level on RSI as we were when price volatility was higher. So there's bullish divergence here on the VIX, and now the MACDs are above zero. This looks to be the beginning of a corrective pattern in the markets, and the VIX is confirming. Again, there's this bullish flag here that's happening on the weekly. It's for the last 2 years. Volatility, every time it's hit this point, it's been smacked down. But notice here, finally on the weekly, it's broken above the 50, and so I think this time around it might just break this trend line. So we'll see if it does, and if that happens, expect to see significant downside in the equity markets. Again, this is the monthly perspective. Same thing, still in the bullish pattern, but until this trend line breaks higher, we're still likely to head lower. But look at the MACDs, they're starting to curl up. That's very, very crucial. It hasn't happened in 2 years, basically. If we break above 50 on the monthly RSI, this correction in the markets will be confirmed and likely will premeditate a recession in the U.S. Looking at the world markets, we've been hitting new highs, but we've been diverging lower. That's very, very negative price action. Taking a look at the weekly, still very overbought, but we broke below this upward channel that we had in 2017. So let's see, and the MACDs are now below zero, so that's another area of concern. And finally, on the monthly, this is something we pointed out. We've got this kind of double top potentially around the 2000 level, but this RSI is very, very crucial. If we cannot break above this 69 level on the monthly RSI, which coincides with the breakdown right here that happened in 2008, we think that this is going to create a multi-month pullback here amidst of a bull market that's really in place. So we firmly believe that emerging markets are in a bull market. That does not mean that we can have a 10 to 20 to 25 to 30% correction and still be in a bull market. So if this corrective pattern does take place, I would expect to see a pullback to that middle Bollinger Band around 1780 area. So that could be a pretty sizable move, and people will panic. But for us, when you're taking a look at a chart since 95, that's still a very bullish move. Anyway, guys, thank you very much for watching. Feel free to follow us on StockTwits at Moniology, Twitter at Moniology, and please have a look at our Patreon campaign and support the work that we do. If you appreciate the videos and you find them to be valuable, send us a monthly patron of $10 a month. It'll go a long way. If we can get 500 supporters of the work, we can create more videos, better quality videos, and hire some significant, some very good technical analysts to add to the work that we're already doing. So guys, thank you again for your support, and have a wonderful week and good luck trading.